Welcome to the Deep Dive. Our mission today, to really unpack the key insights from Campbell's recent Q3 earnings call for fiscal 2025.
That's right. We've got the transcript, the slides, all the material, and we're going to boil it down for you. Basically a shortcut to understanding their performance, what's happening in their different divisions, financials, and their outlook, all straight from management.
Perfect. So let's dive right in. The big picture. How did Campbell's actually do in Q3? What was the headline?
Well, the headline's pretty positive, actually. Q3 earnings performance, it exceeded expectations, the main driver.
Right.
Really solid contributions from their meals and beverages business.
Okay, so meals and beverages, M&B was strong. Was that the whole story, though?
Not quite. I mean, M&B definitely had strong performance, and, they got a boost from some favorable shipment timing near the end of the quarter.
Yeah.
But that strength was kind of offset by a more mixed performance over in the snacks division.
Right, so M&B pulling the weight. How did all this Q3 action impact their outlook for the full year, fiscal 25?
They reaffirmed the full year guidance ranges. So net sales, adjusted EBIT, those ranges hold. However, and this is important, they did narrow their expectation for adjusted earnings per share. They're now guiding towards the low end of that previous range.
Ah, okay. And what's behind that slight downgrade on the EPS outlook?
Yeah, that's directly linked to the snacks business. The recovery there is just happening slower than they originally anticipated.
Got it. Snacks is the key watch item then. Now, what about those potential import tariffs we've been hearing about? Are those baked into this guidance?
No. And they were very clear about this. Any uncertainty around potential import tariffs, retaliatory actions from other countries, none of that is factored into the guidance range. They did give a separate estimate of the potential hit, which we should definitely dig into later. It's a bit complicated.
Definitely want to circle back to that. Okay, before we get into the segment specifics, was there any broader positive trend they highlighted across the whole company?
Absolutely.
Yeah.
And this is a good sign for underlying demand, I think. They pointed to their fifth consecutive quarter of flat or even positive volume across the entire business. For Q3 specifically, organic net sales grew 1%, and that growth was actually driven by volume.
Volume growth is good.
Right. Although they did note that the volume growth was slightly ahead of their actual in-market consumption performance for the quarter. They put that down to that favorable shipment timing we mentioned, both in the base business and related to the Rouse ERP integration.
Okay, so volume momentum is there, but need to watch that timing piece. Let's dive into meals and beverages first. The numbers look pretty strong there, didn't they?
Oh, yeah. Reported net sales for M&B, up a hefty 15% in Q3. Now, a big chunk of that was the Rouse acquisition being included, obviously. But even organic net sales, stripping out currency and acquisition impact, we're still up a very healthy 6%.
And what drove that organic growth?
That was actually led by volume and mix growth, a positive 7% on volume mix, though partly offset by lower realized net price. Operating earnings for the division were also up by 8%.
Okay, so sales up strong, 15% reported, 6% organic, but operating earnings only up 8%. What's the margin story there? Was there some compression?
Yeah, you picked up on that. The operating margin for M&B was actually lower year over year by about 100 basis points. Main reasons: lower realized net price, so maybe more promotions or different pricing, and also the mixed impact from Rouse. Rouse is higher margin, but it wasn't in the base for the full prior year quarter, so that comparison drags the margin rate down a bit.
But they still managed an 8% increase in operating profit despite that margin pressure.
Exactly. They managed to offset the remaining cost headwinds pretty well, helped by that strong volume and mix growth we talked about, plus productivity gains, cost savings programs, and lower operating expenses as a percentage of sales, just because the sales number was bigger.
Okay, so cost controls and volume leverage helping out. What about the bigger picture? What consumer trends are supporting this M&B strength?
This is really interesting. Management directly tie the M&B strength to people cooking more at home. They said consumers are looking for ingredients, things that help stretch their budgets. And they're actually seeing the highest levels of meals prepared at home since way back in early 2020.
That makes total sense. More home cooking means more soup, broth, sauces.
Right. It's a clear tailwind for a lot of their portfolio.
So let's talk specific brands within M&B. What's really clicking?
Well, condensed cooking soups are still a star performer. Sixth straight quarter of dollar share growth. Both dollar and volume consumption up, and they outperformed the segment overall. They specifically called out a mac and cheese marketing push, drove the 11th consecutive quarter of share growth there. Get this, it added about 1 million households. Over half were millennials, highest penetration gains in 4 years for that.
Wow, 1 million households, mostly millennials. That's a serious impact from targeted marketing on a core brand. What about broth?
Broth is another bright spot, yeah. The category itself is glowing because people are cooking more. And Campbell's is really outpacing the category here, gained almost 3 points of dollar share. Swanson saw strong consumption and volume, and they've held or gained millennial households for 7 quarters straight now. And Pacific, their other brand, continued to see double-digit consumption growth.
Okay, strong showing in soups and broth. Italian sauces now with Rouse in the fold. How did that look?
The overall Italian sauce category grew about 2 points in Q3. Prego consumption in Q3 itself lagged a little bit year over year, but management said that was mainly due to promotional timing shifts. If you look year to date, Prego consumption is much more in line with the category and is doing well on share, especially if you exclude that really premium, ultra distinctive segment where Rouse competes.
And Rouse itself, the big acquisition, how's it doing?
Rouse consumption growth in Q3 was basically in line with the overall category growth, but it did underperform Campbell's own internal expectations for the quarter. Management flagged a few things, lapping some unusual promotions from last year that were below their typical premium price, maybe some consumer sensitivity to higher prices right now, and just more competitive promotional activity in general.
So, still growing with the category, but maybe not quite the rocket ship they hoped for initially, facing some headwinds. What about ready-to-serve soups and V8?
Ready-to-serve soups saw some declines in in-market consumption. Management said this was mainly because of increased competition, running more promotions, and also because they discontinued their Well Yes brand. But within that segment, their brands like Chunky, Pacific, Rouse, and Homestyle actually gained share. So some strength within the portfolio despite the overall segment pressure. And V8, on the beverage side, they described as having stabilized over the last 9 quarters or so. V8 Energy is apparently showing double-digit growth, which is good.
Okay. Now let's loop back to that timing factor you mentioned for M&B. You said favorable shipment timing boosted the Q3 results. Did they quantify that? And is it going to reverse?
Yes, they did address it. They estimate about 1/3 of the organic M&B growth in Q3 came from underlying trends. The strength in condensed, broth, Rouse performance. The other 2/3, that was related to the timing of customer shipments right at the end of the quarter, both base business and shipments tied to the Rouse ERP integration finishing up. And yes, they absolutely expect this timing benefit to normalize, maybe even reverse in Q4. They're anticipating roughly a 3-point headwind to organic net sales in M&B in Q4 because of this timing shift unwinding.
Okay, good to know. So some Q3 strength borrowed from Q4, essentially. What about private label recovery in this segment? Any update?
Yeah, they mentioned that private label recovery in M&B has actually been slower than they initially thought it would be. But they did say they're confident that their supply chain is meeting the demand that is there for private label.
All right, let's completely switch gears now to the snacks business. This was clearly the tougher segment this quarter. How did the top line numbers look?
Yeah, definitely tougher. Reported net sales for snacks were down 8% in Q3. Now, that includes the impact of selling off a brand, a divestiture. If you look at organic net sales, excluding the divestiture and currency, they were down 5%. And that decline was driven mainly by lower volume and mix, which was also down 5%.
And that flowed through to profit.
It did. Operating earnings for the segment declined 13%, mostly due to lower gross profit from that lower volume.
Ouch. What about the margin picture in snacks?
Operating margin in snacks decreased 90 basis points compared to last year, landing at 14.3%, mainly driven by higher selling expenses as a percentage of sales, plus that lower gross profit. But it's worth noting, the margin did improve sequentially by 300 basis points compared to Q2. Management said that was thanks to better supply chain costs kicking in, which they had kind of expected.
Okay, sequential improvement is good, but still facing year-over-year pressure. What are the main headwinds hit in snacks right now?
Management pointed to a couple of key things. First, just more pressure on snacking categories overall in Q3, sequentially, and combined with that, more intense competitive activity. Second, they talked about weaker consumer sentiment. People are being more careful with discretionary spending, and snacks often fall into that bucket, right? Overall, their main snacks leadership brands saw consumption decline 3% in the quarter.
A 3% consumption decline. Can they break that down? Is it the whole market dragging them down, or is it their specific performance?
They did break it down. They estimate about 2/3 of that 3% decline was because the snacking categories themselves worsened, basically. Weaker consumer confidence, shrinking the pie.
Right.
The other 1/3 they attributed to their own in-market performance. So category trends are the bigger issue, but they acknowledge they have execution factors too.
Okay, let's drill down into the brands within snacks. Were there any bright spots?
Yes, some. In bakery and cookies, they actually outperformed the category, saw stable consumption. They highlighted continued momentum in Pepperidge Farm Fresh Bakery. The Farmhouse Brioche platform drove the best volume and dollar share growth in 9 quarters for that part of the business. And Pepperidge Farm Cookies also did well. The Milano White Chocolate launch. Strongest household penetration gains for Milano in 9 quarters, and it brought in a younger crowd. LTO's limited-time offers like Caramel Cafe Ole and London Fog helped too. The focus seems to be on innovation, hitting that indulgence need.
Good to hear Pepperidge Farm holding up relatively well. How about pretzels?
The pretzel category grew consumption in the salty aisle, but maybe not as much as the broader salty snacks market. Snyder's of Hanover, which they position for, like traditional pretzel leaders, they're managing assortment, investing in convenient packs, but management kind of admitted it wasn't quite enough against the competition. Snack Factory, though their brand that's sort of reimagining pretzels with things like pop-ups and bites, that expansion into the salty aisle, was successful. They're seeing strong repeat purchases, expecting that to drive momentum.
Okay. Crackers seem like a tough spot, especially Goldfish. That's a huge brand for them.
Yeah, crackers are definitely feeling that pressure from consumer sentiment. Their decline in crackers looked pretty big, but part of that was lapping a really strong launch period for Goldfish crisps last year in Q3. While Goldfish had some bright spots, like a Harry Potter Butterbeer LTO that's limited time offer again, management basically said they have work to do to reinvigorate the core Goldfish brand.
So what's the plan for Goldfish?
Focus on core relevance, more marketing support, strategic promotions, really leaning into the back-to-school season. And they emphasized using price pack architecture PPA, different size packs at different prices. Like a 2.5-ounce grab bag is an affordable entry point, exploring multi-packs. The idea is to focus promo dollars where they get the best return, hitting the right price points, not just spending more overall.
Smart. Focusing on ROI and value makes sense right now. What about chips?
Chips, they feel, are well-positioned, but still facing tough competition. They've seen good response to innovation, things like kettle avocado oil, air-fried options. They've increased household penetration with better-for-you offerings. Consumption for their chip brands was pretty much in line with the broader chip category, but maybe a bit short of what they hoped for in the specific kettle tip segment. Plans involve optimizing distribution, promotion, and more limited edition flavors for summer. Oh, and they also mentioned that part of the gap between their organic sales decline and the consumption decline in snacks is due to trimming down some third-party partner and contract manufacturing business as they focus more on their own core brands. Looking ahead for snacks then, what does the recovery timeline look like now? When do they expect things to get better? Well, they've pushed it out. They now expect the snacks recovery to really take hold in fiscal 2026. They had previously hoped things would be flat by the end of this fiscal year, 25. And to get there, management hinted they might need to lean into marketing spend more next year. They're currently at the low end of their target range for M&S spend. They also flagged a bigger headwind from incentive compensation next year compared to this year, which would impact segment profit.
So recovery delayed to FY26 might need more investment, plus a comp headwind. What does management think needs to happen for the overall snacks categories to bounce back?
2 main things, they said. First, you need an improvement in overall consumer confidence, so people feel okay about discretionary spending again. And second, they need to keep meeting consumer needs through innovation, whether that's value innovation, better for you, or indulgence in new experiences. They describe the changes they need to make as surgical, not like a total overhaul of the business.
All right, let's pull back and look at the broader financials and guidance details that connect everything. Rouse was obviously huge for the reported numbers.
Yeah, Rouse was a big contributor in Q3 reported results. And it started counting towards organic growth mid-quarter, once they passed the 1-year acquisition anniversary on March 12th. Also, they finished the ERP integration for Rouse early in Q4. ERP, that's the big system managing business processes. They expect that integration to unlock more back-office savings, IT, finance, order management, starting next fiscal year, FY26. They said the integration's going better than expected.
And divestitures impacted the reported numbers too, right? Made the comparison look weaker.
Correct. Selling off Pop Secret and the NUSA business earlier definitely created a headwind on reported net sales compared to last year.
Okay, let's isolate the base business gross margin for a second, ignoring Rouse and divestitures. How did that perform?
Base business gross margin took a hit of about 80 basis points from that net price investment, promotions, et cetera we discussed, and about another 20 basis points from other cost headwinds. But they largely managed to offset inflation and supply chain costs with productivity gains, cost savings programs, and that favorable volume mix in the base M&B business.
Speaking of cost savings, how's that big $250 million program going?
Pretty well, actually. They've delivered $110 million in savings year to date under that program they announced last September. And because things are going well, including getting savings from the Rouse integration and network optimization faster than planned, they're actually increasing their target for this fiscal year, FY25, now expecting $130 million in savings, up from $120 million.
Ahead of schedule. Nice. How about operating expenses? Marketing, selling, admin?
Combined M&S and admin costs went up slightly in dollar terms, mainly because Rouse was included for part of the quarter. But as a percentage of net sales, those combined costs actually improved compared to last year, just because the sales base was higher. Advertising and consumer promotion specifically was up 3% due to the acquisition, but adjusted admin expenses were down 4% thanks to cost savings and some early Rouse integration benefits.
Okay, let's look bottom line, adjusted EBIT and adjusted EPS. How did they shape up?
Adjusted EBIT was up 2% in Q3. That was mainly driven by lower admin, R&D, and other expenses, plus the higher adjusted gross profit, partially offset by higher marketing and selling costs. Adjusted EPS, though, was down 3% to 73 cents. The EBIT growth just wasn't enough to overcome higher adjusted interest expense. That was due to both more debt after buying Rouse and just higher interest rates overall. Importantly, they did say Rouse was accretive to adjusted EPS in the quarter itself.
How's cash flow looking? And are they still investing in the business through CapEx?
Operating cash flow year-to-date was $872 million. That's a bit lower than last year, mainly due to working capital changes, they said. CapEx, or capital expenditures, year-to-date was $296 million. They're investing in things like expanding chip and cracker capacity, optimizing the M&B network, and general business capabilities. They now expect full-year CapEx to be around 4.5% of net sales, slightly lower than their previous 4.7% estimate, mostly due to project timing.
And what about shareholder returns on the balance sheet?
Returned $343 million via dividends year-to-date. The Q3 dividend per share was up 5%. They also bought back $60 million in shares, mainly to offset dilution. Their leveraged net debt to adjusted EBITDA improved slightly from Q2 down to 3.6 times. Yeah, still focused on getting that down towards their goal of 3 times. They ended the quarter with $143 million cash and access to a $1.5 billion credit facility.
Okay, let's revisit. Those tariffs you mentioned are not in the guidance. What's the potential impact they flagged separately?
Right, because the trade situation is so uncertain. They estimated a potential net incremental headwind of up to 3 to 5 cents per share on their fiscal 2025 adjusted EPS just from tariff-related costs.
Up to 5 cents. Wow. What specific tariffs are driving that estimate?
It's a mix, and it's phasing in. Includes Canadian retaliatory tariffs that started in March, Section 232 tariffs on tin plate and aluminum, hitting them starting in Q4, and then potential reciprocal actions from other countries, which could impact Rouse, since it's made in Italy, also potentially starting in Q4. Now, that 3-5 cent estimate does include mitigation steps they're already taking, things like managing inventory strategically, working with suppliers looking for alternative sources, product cost optimization, maybe some very targeted pricing actions. They also warned not to just multiply that 3 to 5 cents by 4 to get a full year impact for FY26, because the situation is changing, and some fixes take time. For Rouse specifically, they're working with their supplier, building inventory, optimizing costs, and maybe even shifting some production to their Alma facility, though Italy remains the main source.
That definitely sounds like a moving target and a layer of complexity for them. Lastly, they mentioned a 53rd week this year.
Yes. Fiscal 2025 is a 53-week year for Campbell's. Most are 52. That extra week is included in their formal guidance. They estimated adds about 2 points of growth to reported net sales and adjusted EBIT, and around 5 cents to adjusted EPS.
And their latest view on inflation for the rest of the fiscal year?
Expecting core inflation in the low single-digit range for the full year. They think productivity and cost savings will mostly offset it, but they do expect inflation to tick up in the second half compared to last year, and also sequentially from the first half. So still some pressure there on cost of goods.
Okay, pulling this all together then. From an investor's angle, why does this deep dive into the Campbell's call really matter? What's the key takeaway?
I think it really highlights how a big CPG company like Campbell's is navigating, well, almost 2 different economies at once. You've got the meals and beverages side benefiting from value-seeking consumers cooking more at home, stability, even growth there. Then you've got the snacks side facing pressure from cautious consumers, cutting back on discretionary items, and facing intense competition. It's a real split.
Yeah, it really underscores how important execution is and tailoring innovation, like you said, PPA for value and snacks, but also premium indulgence like Milano to fit those very different consumer mindsets.
Exactly. And it shows the real financial gears, grinding, integrating acquisitions like Rouse, driving cost savings really hard, while also having to deal with external curveballs like potential tariffs.
So it demonstrates that management is juggling short-term execution in this tricky environment while also trying to build for the longer term, especially trying to get snacks back on a solid footing.
Precisely. It's a balancing act for sure. Execute now, but also position for future growth when or if consumer behavior shifts again.
Thinking about that split the strength in value-driven home cooking versus the pressure on discretionary snacks, what does that suggest longer term? If consumer confidence stays bumpy, does value just keep winning over premium or indulgence in food?
That's the million-dollar question, isn't it?
Yep.
I mean, this Campbell situation suggests companies really need to be strong across different price tiers. If confidence stays weak, yeah, value offerings, things that help stretch budgets, better for you, that feels practical. That probably stays resilient. But people still want treats, right? Premium indulgence, unique experiences. Maybe they just buy them less often or more selective. It points to a really nuanced market where maybe you can't just bet on one end of the spectrum. You need that surgical precision Campbell's talked about.
A really interesting point to chew on. Okay, that wraps up our deep dive into the recent Campbell's earnings call transcript. Remember, this analysis was based only on the source material provided to us. Think of it as your shortcut to getting up to speed.
Yeah, hopefully saves you some reading.
Now, for our favorite speculative segment, this is not financial advice. Please do not take this seriously for your portfolio. But given that snacks recovery is officially slower than hoped, management might need to spend more on marketing next year. They face a higher incentive comp headwind, plus this tariff uncertainty. Maybe the most outrageous, yet just plausible enough, trade idea isn't just long or short the stock. What about a complex options play? Betting on increased volatility around their Q4 results and when they give that crucial FY26 guidance, like structuring a spread that profits if the stock makes a big move up or down, maybe hedging against the downside risk in snacks or tariffs, but capturing any sharp reaction to the FY26 outlook. Volatility itself could be the play here. Again, just spitballing for fun, do your own research, talk to a pro.
Yeah, with all those moving parts you just listed, betting on things getting a bit choppier on Q4 doesn't sound completely crazy, does it? But definitely not advice.
Definitely not. Thanks for joining us for this deep dive. If you have sources you want us to tackle, let us know. Stay curious.